You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, well, the market settled down a little bit, then they didn't settle down, and now they're continuing to not settle down, and we just got a very crazy market out there. Actually, around earnings, it seems like we actually had a little bit of a push forward in the marketplace. Now we're retracing. We're giving a lot of that back. There's a lot of concerns about a recession. And there's just overall marketplace, there's going to be a lot of concerns until they, quote unquote, have a vaccine or some type of cure for the coronavirus COVID-19. So with that said, we're going to still do a play on volatilities. All the volatilities have came off quite a bit since the biggest concern of the pandemic about a month ago when we kind of hit the bottom as far as the S&P 500 index and the NASDAQ index. But I'm seeing today, and I got to highlight here that we're taping Options Playbook Radio, and it is May 13th. The markets are closed at this point in time. And we're going to look at the FANG stocks. FANG stocks have been in the news, as always, but more so than a lot of the other companies. FANG stocks are still hanging in there pretty good. Today, Google, and we're going to look at Google, which is actually Alphabet. There's a Goog, G-O-O-G. Today, we're going to look at G-O-O-G-L as the symbol. And as always on Options Playbook Radio, nothing that we talk about is meant to be a recommendation. We're just going to try to learn here. And one of the things that I kind of picked up and in this new norm, if you will, as far as implied volatility is concerned, where the VIX being at 30 would be considered low volatility over the last month or so. So we're kind of seeing the VIX. The VIX has gone a little bit higher this week. It's up above 30%, but we did actually have a point in time where it was below 30%, which was kind of surprising to me considering everything that's going on. Actually, I would consider the VIX to still be up. I figured 40% would be a very solid implied volatility, but we've came off. That means that the fear is waning a little bit, even though there's really no answer to what's going on with the coronavirus. I guess the fact that the markets are opening up and they're looking to get the economy going a little bit, I don't know if that adds less fear or more fear to the actual overall marketplace. But with all that said, I want to get back into one of the strategies I like to talk about the most here on Options Playbook Radio, which is the skip strike butterfly. I prefer doing these type of trades after earnings. And I kind of mentioned it before that we had everything going on with the VIX up around 40, 50% implied volatility. Then we're going into earnings. And then we had stocks like Alphabet, Google, Facebook coming on out and announcing earnings. And all those companies have a tendency to move around earnings quite a bit. And they're fairly expensive companies. So I kind of wanted to avoid them around earnings. So the trade this week is, once again, not meant to be a recommendation. It's just that we always look for strategies that meet conditions, not necessarily what our forecast would be on Google. I'm going to do a skip strike butterfly with call options, and it's all based off of the option pricing. So Google at this point in time, I have the Ally Invest implied volatility chart up here, and we see that the historical volatility, the actual volatility, is still quite a bit higher than the implied volatility. So right now I see the implied volatility trading around 30% on a 30-day basis, and the historical volatility is up around 46% implied volatility on a 30-day basis. So the vol has dropped off tremendously versus the lows in the marketplace. At the lows, which is in about looks like about the middle of March when the volatility hit the highest, the 30-day implied in Google, and that was right up around 72%. So we want to still sell some of that premium. We want to bring in some net credit, but we're going to try to get ourselves a little bit of upside, and maybe if we can get Google to come a little bit in our direction in the short term, maybe we can get a little bit more than just the net credit received. And that's what in skip strike butterfly is all about. So Google was down today. Google was trading at 1348.33. It's down 26.85. I'll highlight that it's May 13th. The market is closed. If I'm going to do a skip strike butterfly, the first place that I start looking is to look at the most at the money long straddle. And I always just kind of round off here. It's not an 100% exact science, but it gives me kind of a starting point as to where I'd like to pick my strikes. So if I look at the money long straddle on the May 15th expiration, which is a very short-term trade here. So you're going to have all day Thursday, all day Friday for this to trade. And on that expiration, we see that the at the money long straddle is trading for about $30 in that instance. So if I round up on Alphabet and where it closed, or Google, we're going to call it Google going forward, at 1350, add 30 points to that, 1380 is a potential price that could occur in Google. That's basically the over-under. Could it go up 30 points or could it go down 30 points? And that's about what the marketplace is expecting. If it does more, it did more than the marketplace was expecting. If it does less, it did less than what the marketplace was expecting. But that's the over-under, the line in the sand. So based off of that, I want something that's going to be, I'm going to set my butterfly strikes above that 1380 level. In other words, if we get a little bit more move than what is anticipated, we're hoping that it will land in between our butterfly strikes. So the trade that I'm going to look at, and the trade that we're going to look at, let's make the official paper trade right here. We're going to look at the May 15th expiration. That's only got 2 full days of trading left. Obviously, the markets are closed, so the markets are going to be a little bit wide here. On this May 15th expiration, we're going to buy the 1375 call. We're going to sell 2 of the 1380 calls, and we're going to buy 1 of the 1405 calls. Now, that entire trade, that is a skip strike. That means that we're skipping the 1395. That would be the normal butterfly. And this allows us to get it done for approximately a net credit. Right now, I'm seeing that midpoint net credit at about 15 cents, but the markets are really wide. I would really like to get around 20 cents if I'm going to do this, but I'm going to take what the market is at. We're going to look at a net credit of 15 cents to the account. Now, what is the risk reward of doing this trade? If I do this trade, I'm doing it for a net credit to the account. So if the market continues down, like it follows the lead of today's market and continues on down, the net credit to my account would be that 13 cents. All the option contracts would expire worthless on the Friday close. And if the stock was below 1375, or basically where it's at, 1348, all these options would expire worthless, and I would get that net credit of 13 cents to the account. Now, the ideal scenario would be that the underlying did go up 30 plus points, right? The expected move. Our short strike is at 1385. If we're right at expiration and the stock stops right at 1385, which good luck with that, a very low probability. But if that did happen, our maximum upside would be achieved. That means that we would receive $1,000 for our call spread between the 1375 and the 1385. Right? And then our short spread that makes our butterfly would expire worthless. So we'd have $1,000 plus the net credit received of 15 cents, and that would be my max gain to the account. So the width between the first call option and the short option is going to determine what my maximum can be on this trade. And that's 10 points. So you take that 10 points and you times that by 100, which the contracts represent, and we end up with $1,000, and then the net credit is 13 cents, times that by 100, and you'd have $1,013, and that would be your max upside. Okay, so now where does the risk come in? I told you the good, we got to tell you the bad. So in this scenario, when I said that we skipped that 1395 strike, when we skip that, what we're really doing by skipping that strike is embedding a call credit spread in here. And if we got enough volatility, like as we do in this marketplace, that call credit can pay for the butterfly. And in this instance, with the markets closed, we're showing that the midpoint is around 15 cents. And that means that we're bringing in more credit from the credit spread than the cost of the standard butterfly, if you will. So our risk kicks in from 1395 to 1405. From 1395 to 1405. So that's 10 points. And once again, if you take that 10 points, you multiply it by 100, which contracts represent, that's $1,000 of risk. So my sweet spot in this trade is really anywhere from 1375 all the way up to 1395. If it lands anywhere in that range, which is a 20-point range on Google, we're okay. We're okay on this trade. If it goes beyond that, well, we have limited and known risk, and that limited and known risk would be 10 points or $1,000 for every 1 by 2 by 1 butterfly that I put on. All right. Now that $1,000, obviously you could talk about that net credit of 13 cents, but that's just a little bit of minutia here that basically would cover your commissions. So if I was doing this trade and the markets were open, I might want to try to get a little bit more credit than what the midpoint is at, but with that said, the goal here is to do this entire trade for at least a net credit. That way, if the market continues on down in Alphabet, then in that instance, we're still going to be profitable, quote unquote, on the trade. Not a lot of profit, but we're going to have some type of profit on the trade. We're hoping that the stock will come up, go about the expected move to the upside, the cost of the long straddle, and then close somewhere close to the 1385 mark. So lower probability of having that happen, but then we also have 3 scenarios where this trade does okay. If the stock goes down, we're okay. Stock stays where it's at, we're okay. Stock goes up a little bit, the expected move, we're okay. It's only if the stock goes more than the expected move, all the way up beyond 1395, that we really are concerned. And 1395 minus 1348, where the current stock is, that's a 47-point move over 2 full trading days. So in these times, when we have high volatility without having things like earnings reports or any major news that is coming out, skip strike butterflies are just interesting trades. So you can pick your underlying. If you don't want to do Google, you don't want to find an underlying that you're comfortable trading, where we do have that same scenario where we still have elevated volatility because of where the marketplace is at. And in particular, it's also good to look at underlyings that are fairly high price, because that also adds premium to our option contract. Obviously, Google being a $1,348 stock, that's going to add premium to the option contract just because of the pure price of the underlying stock. All right. Okay, so let's recap the trade. We're at Google. Today is May 13th. The market is closed. Alphabet / Google was down 26.85, which is 1348.33. We're looking to do a skip strike butterfly. We're going to use that May 15th expiration, which is this coming up Friday. We're going to buy the 1375 call, sell 2 of the 1385 calls. We're going to skip the 1395. Do nothing, just skip it. And then we're going to buy 1 of the 1405 calls. We're going to try to get this done for a midpoint net credit of 15 cents. Net midpoint fills are not always guaranteed. Always want to think about commissions when you're putting on this trade. Our maximum upside is $1,000 plus the net credit. Our maximum downside is $1,000 minus the net credit to the account. And that's going to be it for this episode of Options Playbook Radio. If you have a question you'd like us to answer in the show, just please email me. My email address is theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out. Stay safe out there.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.